In this section, we're going to discuss corporate formations and capital structure. When we go into business, we have some choices on how to structure our business, and they have pretty dramatic implications, both tax implications, liability implications, and other implications. So we could be a sole proprietorship. Sole proprietorship is really just an extension of the owner. I just go out and start doing work, and I have formed a sole proprietorship. There's no formal formation requirements. Any tax is going to be reported just on the individual's tax return, Schedule C of the 1040. I do not have any limit to my liability. So I go out and I do work and say I mess up, I hurt somebody, something happens. The person who, if I get sued, I can be sued for everything, my personal home, my personal assets, not just my business assets. I'm going to be taxed at the owner's marginal tax rates, individual tax rates. I might qualify for the qualified business exclusion. We'll talk about that later. My business losses might offset my non-business income, so that's a bonus. I am subject to passive activity rules. I pay tax on all my earnings, whether or not they're distributed, and I'd pay self-employment tax, which is essentially double the Social Security, Medicare, etc. tax. And not all deductions are going to be available to corporations that are available to shareholders, to sole proprietors. So that is a bonus. I could form a partnership. In a partnership, it's two or more people engaging in business together. Again, no formal formation requirements. It's just two or more people who began work together. This is a flow-through entity, so the partnership income flows through to each individual partner. The partnership will file a tax return. It'll file Form 1065, and each partner will receive a K-1. And that K-1 will tell the partner the items of income, expense, loss, etc. to report on their 1040, but the partnership itself does not pay tax. There could be a limited or a general partnership. Under a general partnership, every partner has unlimited liability. But under a limited partnership, there's at least one general partner who still has unlimited liability, but the other partners can have limited liability. So they would be limited to their investment in the partnership. There's no double taxation. The partner's basis in the partnership varies with income and loss, and that basis will determine the tax treatment when a partner exits the partnership. We'll discuss that later when we talk more in detail about partnerships. They pay tax on all earnings, whether or not they're distributed, and they pay self-employment tax. We could form a corporation, and there's a C Corp and an S Corp that we're going to talk about in this course. Corporations are actually separate legal people. They can sue, they can be sued, and they're liable for paying tax. Corporations file a Form 1120, and they're currently taxed at a 20% flat tax rate. Shareholders generally are only taxed when the income is distributed in the form of dividends, but that's double taxation because the corporation has paid tax on that income. When the corporation distributes it to the shareholder, they do not get a tax deduction, and then the shareholder also pays tax on that dividend. There is a dividends received deduction to help with that, but that is between corporations, not individuals. There is limited liability for a corporation, so shareholders are limited to their investment in the corporation. That's what they can lose. You might, as a corporation, pay a reduced tax liability depending on the marginal tax rate of the individuals and the goals of the corporation. Because a corporation can retain funds in the corporation and not distribute them to shareholders to expand and build, you might end up paying less tax since the corporation has a 21% tax rate. But remember, the minute those earnings are distributed to shareholders, the shareholders are taxed again. Employee shareholders are not liable for self-employment tax. Only the employee portion. The corporation would be liable for the employer portion. The employee shareholders are allowed fringe benefits, and the corporation may deduct salaries paid to shareholder employees within reasonable limits. All right. In an S Corp, it has flow-through taxation, kind of like a partnership. So the S Corp doesn't pay taxes directly. The items of income, expense, loss, whatever, flow through to the individual shareholders. The S Corp files an information return. It's an 1120S. The S Corp does have limited liability. It it has to be domestic, and it can only have allowable shareholders. Allowable shareholders are individuals, certain trusts and estates, and it may not be partnerships, corporations, or non-resident alien shareholders. They can have no more than 100 shareholders, and they have only one class of stock. It cannot be an ineligible corporation, which is a financial institution, insurance company, and domestic international sales corporation. It might qualify for the qualified business deduction at the individual level. The earnings tax to the shareholders in the year earned, so you can't retain funds in a corporation and not pay a distribution on them. Earnings tax to the shareholder in the year earned. I can use capital losses to offset capital gains. There's no tax upon distribution of profits because it's already been taxed in the year earned, so it avoids the double taxation problem. All right, I could also form a limited liability company. That's an LLC. It offers limited liability to owners, and it's treated as a partnership for tax purposes. You can have an unlimited number of owners, and they can be individuals, estates, trusts, and corporations. The LLC is a very popular form of business right now because it kind of combines the best of both worlds of the corporation and the partnership. I could also form an LLP, which is a limited liability partnership. And it is a partnership, but it offers limited liability to partners. But when we say limited liability, we mean it limits the liability of other partners in their business, but it's not going to limit the liability with the individual acts under that partner's direction. So if A, B, and C are in a partnership, an LLP, a limited liability partnership, partner A is not going to be liable for acts of partner B and partner C. Partner A is still going to be liable for acts of partner A and then acts that partner A may have directed. So if partner A directed an employee to do something illegal, partner A is still going to be liable for that. We also have what we call check the box regulations, and it allows disregarded entities and limited liability partnerships and limited liability companies to choose to be taxed as corporations if they want to. If they make that election, they can't change the election for 5 years after it is made. All right, so we have Alice and Bill. They want to go into business together. For the first 2 or 3 years of operations, they anticipate losses, which they would like to use to offset income from other sources. They're also concerned about exposing their personal assets to business liabilities. Advise Alice and Bill as to what form would best meet their needs. So they want to be able to use their losses to offset income from other sources, so non-business income. And they also do not want to have unlimited liability. So a sole proprietorship and a partnership are both going to have unlimited liability, so those are out. A corporation is going to have limited liability, but they're not going to be able to use those losses to offset income from other sources. So that is out. So that's going to leave us with a corporation with an S selection, so an S corp. It's going to allow losses to flow through to Alice and Bill, or we could use an LLC. It's also going to allow losses to flow through to Alice and Bill, and both the S corp and the LLC will allow limited liability to Alice and Bill. When we form a corporation, we have to follow state incorporation rules, and we can incorporate in any state we wish. It doesn't have to be the state in which the corporation resides or the shareholders reside. We have to abide by the incorporation charter of the state, and that generally requires these 4 things. You have to invest a minimum amount of capital, file an articles of corporation, issue stock, and pay incorporation fees. And corporations usually look around the U.S. and find a state that has the most favorable laws for corporations and incorporate in that state. So for a while it was Delaware. You saw a lot of corporations incorporated in the state of Delaware, even though no one lived in Delaware. When we choose to incorporate, we might have a business we've been working on. Say we have a business and we've just been operating it as a sole proprietorship, but it's getting bigger and we're starting to worry about liability, and we think it would be better for it to be a corporation. So we want to incorporate. Well, to incorporate, we have to contribute things to the corporation and we get stock back. That's usually how it works. But what happens when I contribute something to the corporation and get something back? Well, that is a realization event. So, absent any other rules in the code, that would be a taxable event. And that is not really a great result because not much has changed, right? We're operating this business as a sole proprietorship. Now we're going to operate it as a corporation, but I didn't actually sell any of the assets. I just contributed them to a corporation, which I presumably will control after that contribution. So I'm maintaining my continuity of interest. I'm just exchanging the way that I own those assets. There's also an issue with how would I pay those taxes? If that was a taxable event, how would I actually pay those taxes? Because I wouldn't get any money. It's not like I sold those assets just out on the open market and got cash. I didn't get any money back for those assets. So I'd also have an issue with how would I pay those taxes. That's where Section 351 comes in, and it allows deferral of gain or loss upon incorporation if the rules are met. So the general rule, and this is language directly from the Internal Revenue Code. You could look this up online or you could go to Tarleton's library databases and find the code. It's Internal Revenue Code Section 351. So 351A says, under this general rule, no gain or loss shall be recognized if property is transferred to a corporation by one or more persons solely in exchange for stock in such corporation, and immediately after the exchange, such person or persons are in control, as defined by 368C of the corporation. So the important things in A are that we have to contribute property, it has to be solely in exchange for stock, and we have to be in control immediately after the exchange. Property has been defined by the IRS and the tax court as cash and most assets, including installment obligations, accounts receivable, inventory, equipment, patents, other intangibles. Things that are not property are services. I cannot just go do services in exchange for stock and have a total non-recognition event. Debt of the corporation not evidenced by a security interest. Okay, and I also have to be in control after this transaction. That's defined in Section 368C of the code. That says that ownership of at least 80% of the total combined voting power of all classes of stock and 80% of all other classes of stock. So after this transaction, me or this group of shareholders that are forming this corporation have total control of at least 80% of the voting power of all classes of stock and 80% of all other classes of stock. All right, so there is a slight exception for services. If a person transfers property and services to a corporation in exchange for stock, so they're forming, say I'm a lawyer and I'm forming a business and I transfer a lot of property, but I also transfer some services. I also help draw up the corporate documents. All the stock received will count towards the 80% control limit as long as the fair market value of the stock for property is at least 10% of the stock for services. This Section 351 thing will apply to new and existing corporations, but we still have to meet the 80% rule. And this is on a transaction by transaction basis. So the group transferring each time must own 80%. The exchanges don't have to happen all on the same day, but they must be part of the same plan. All right, and then solely for stock, some other things that are important there are that if I get something besides stock, then it's gonna be treated as boot, and I'm gonna have some gain on that. I'm gonna have to recognize gain. The stock also must be qualified stock. Usually all preferred and common stock is qualified stock. But preferred is not qualified if it contains some debt-like feature, like forced redemptions or dividends tied to interest rates. And then back to the slides, Section 351B, receipt of property, says if subsection A would apply to an exchange, but for the fact there is received in addition to the stock permitted to be received under A, other property or money, then gain to such recipient shall be recognized, but not in excess of the amount of money received plus the fair market value of such other property received, and no loss to such recipient shall be allowed. So this is boot property. It's when I contribute assets to a partnership, and in return I get stock plus some other property. That's boot property. I recognize gain to the extent of my gain or the amount of money received, but I'm not allowed to recognize loss. All right, so looking at question 2-12, does Section 351 require shareholders to receive stock equal in value to the property they transferred? Suppose Fred and Susan each transfer property worth $50,000 to Spade Corporation. In exchange, Fred receives 25 shares, but Susan receives 75. Are the Section 351 requirements met? So they each transferred $50,000 worth of property, but Fred only got 25 shares and Susan got 75. 351 is still met. 351 does not require equal valuations of shares in return. So this is still a non-recognition event with regards to Section 351 and contributing property to a corporation. Now, there may be other tax consequences. Fred may be treated as paying some money to Susan, either compensation, making a gift, making a loan, something like that, because there's probably a business reason. Fred received only 25 shares and Susan received 75, and there are probably going to be tax consequences for that business reason, whatever it ends up being. Question 2-13, does Section 351 apply to property transfers to an existing corporation? Suppose Carl and Lynn each own 50 shares of North Corporation stock. Carl transfers property worth $50,000 to North for an additional 25 shares. Does Section 351 apply? Explain why or why not. If not, what can be done to qualify the transaction for Section 351 treatment? Okay, so the first question, does Section 351 apply to property transfers to an existing corporation? Yes, it does. Section 351 is not only for the formation of a corporation, it's also for contributions after formation. Okay, so continuing on, Carl and Lynn own 50 shares. Carl then later transfers property worth $50,000 and for an additional 25 shares. All right, so in this particular transaction, 351 is not going to allow for non-recognition because Carl is not in control. Carl owns 75 shares. He had an additional 50. He got 25 more. He owns 75 shares out of 125 shares. That's only 60%. So each transaction, the group of transferees to the corporation have to own 80%. So this transaction is not going to qualify because he only owns 60%. To make it qualify, Carl would have to acquire 200 of 250 shares, so he would have to transfer a lot of money or a lot of property. Or an easier way to make it qualify would be Lynn could also transfer property when Carl transfers property, because together Lynn and Carl own 100%. To make that work, Lynn would have to at least transfer property worth $10,000. It has to be a nominal amount, and Congress has set that nominal amount at $10,000. So if, in this transaction, if Carl contributed $50,000 and Lynn contributed $10,000, and Carl got 25,000 shares or 25 shares and Lynn got 5 shares, that would qualify for 351 treatment because after that transaction, both Lynn and Carl together own 100%, which is over the 80% requirements. All right, question 2-30. In the current year, Ed, Fran, and George form Jet Corporation. Ed contributes land, which is a capital asset, having a $35,000 fair market value, purchased as an investment 4 years ago for $15,000 in exchange for 35 shares of Jet stock. Fran contributes a machine purchased 4 years ago and used in her business in exchange for 35 shares of Jet stock. Immediately before the exchange, the machine had a $45,000 adjusted basis and a $35,000 fair market value. George contributes services worth $30,000 in exchange for 30 shares of Jet stock. All right, so we have this transaction and we're trying to see if it qualifies for 351 treatment. So the contributors of property don't recognize or realize those recognized gains. So total we have 35 shares for Ed, we have 35 shares for Fran, and we have 30 shares for George. So 70 shares have been transferred because of a contribution of property, but 30 shares have been transferred because of a contribution of services. So remember, for 351 to apply, there has to be a transfer of property solely in exchange for stock. And after that, they have to be in control. So George messes this whole thing up because his shares were contributed not because he contributed property. His shares were given because he contributed services. So his shares drop out. So Ed and Fran only own 70%. They do not satisfy the control requirement. Knowing that, let's go through the questions. A, what's the amount of Ed's recognized gain or loss? Ed contributed land, which is a capital asset, having a $35,000 fair market value. They purchased it as an investment for $15,000. So he has a $20,000 gain because the 351 requirements haven't been met. So Ed recognizes a $20,000 gain. $35,000 is what he received. The value of the stock he received minus his $15,000 adjusted basis. B, what's Ed's basis in his Jet shares, and when does his holding period begin? We haven't really talked about this, but if the non-recognition provisions do not apply, then the basis is just the fair market value basis. It's just like he went out on the open market and bought those shares, and if he did that, the basis would be what he paid for them, and he would have paid fair market value. So here the fair market value of those shares is $35,000, so he has a $35,000 basis in the shares, and his holding period is going to start on the day after the exchange. In part C, we want to know about Fran. What's her recognized gain or loss? Fran contributed a machine. She purchased it 4 years ago, used it in her business. The machine had a $45,000 adjusted basis and a $35,000 fair market value. So she has a loss on this machine. She has a $10,000 1231 loss, and then her basis in the shares is $35,000, the fair market value. Her holding period begins on the day after the exchange date. So that was part D. We answered part D. Going on to E, how much income, if any, does George recognize? George is going to recognize as income the fair market value of the shares he received. So he received 30 shares worth $30,000. So he's going to have $30,000 of ordinary income. This is income from services, so it is ordinary income. F, what's his basis in the shares and when does his holding period begin? He has a fair market value basis in the shares of $30,000, and his holding period is going to begin the day after the exchange date. All right, and then H. How would your answers to parts A through G change if George instead contributed $5,000 in cash and services worth $25,000 for his 30 shares of Jet stock? Okay, so what happened here? Now he contributed cash and services. All right, so now the 351 requirements have been met, right? Because he now contributed property and services. And so we meet that exception that says if a person transfers property and services, all stock received by that person will count towards the 80%. So now we have 100% ownership between Ed, George, and Fran. All right, so now we want to know how the answers would change. So we're starting with Ed. Now Ed is going to recognize no gain or loss. And in part B, he's going to have a transferred basis. So he's going to take the basis that he had in his asset, which was land. He had a $15,000 basis in land. It's going to become the basis in the Jet shares he received. His holding period is just going to continue. It's going to be deemed to begin 4 years ago when he originally purchased the land. It's going to be a transfer holding period. Fran also is going to recognize no loss on her machine because she contributed only property and received only stock. She is going to take a transferred basis. So it's going to be a $45,000 basis in the Jet shares. And her holding period is going to be deemed to begin when she purchased the machine. Okay, and finally, George. George contributed services of valued at $25,000 and cash of $5,000. So George is going to recognize some income. George is going to recognize $25,000 of ordinary income as compensation for services. And then in part F, what is his basis in the shares? It's going to be $30,000. So it's going to be the $5,000 in cash is kind of like the transferred basis. And then to that, we're going to add the $25,000 for the fair market value of services. And his holding period is going to begin the day after the exchange date. Now we're looking at problem 2-31. In which of the following independent situations is the 351 control requirement met? So let's look at A. Olive transfers property to Quick Corporation for 75% of the Quick stock, and Mary provides services to Quick for the remaining 25% of the Quick stock. Okay, so we know it is not met here. The control requirement has to be 80% of the corporation, and it has to be in exchange for property. So in Part A, the control requirement is not met. Transfers of property received only 75% and do not have 80% control. Part B, Pete transfers property to Target Corporation for 60% of Target stock, and Robert transfers property worth $15,000 and performs services worth $25,000 for the remaining 40% of Target stock. Here, the control requirement is met. We saw this in the last problem we just did. Robert transferred more than a nominal amount of property, and the 80% control requirement has been met since all of Robert's stock is counted. So together they own 100% of the corporation. C. Herb and his wife Wilma each have owned 50 of the 100 outstanding shares of Vast Corporation stock since it was formed 3 years ago. In the current year, their son Sam transfers property to Vast for 50 newly issued shares of Vast stock. So this transaction with Sam, this is an independent transaction. It's not part of the formation transaction. So looking at this transaction with Sam, he owns, after the contribution of property, he owns 50 of the now 150 shares of Vast stock. So this is not going to apply. Control requirement is not going to be met. Sam is only going to own 33 1/3% of the Vast stock immediately after the exchange. There is no stock ownership attributed from Sam's parents to Sam. D. Charles and Ruth develop a plan to form Tiny Corporation. On June 3rd of this year, Charles transfers property worth $50,000 for 50 shares of Tiny stock. On August 1, Ruth transfers $50,000 cash for 50 shares of Tiny stock. Okay, so here, this is a situation where the transfers happened not on the same day and not in the same month. So we have to think back to 351. And remember, 351 doesn't require these transactions to happen simultaneously. So it's okay that Charles and Ruth make these transactions on different dates. What's important is that it tells us they developed a plan. So this is all part of one comprehensive plan to form Tiny Corporation. So this does meet the control requirement. Charles and Ruth own 100% of the Tiny stock. The transfers do not have to be simultaneous. And then Part E, assume the same facts as in Part D, except Charles has a pre-arranged plan to sell 30 of his shares to Sam on October 1. Okay, so that is going to be a problem. 351 doesn't have a rule mandating how long the shares have to be owned after the non-recognition treatment, but it can't be part of a comprehensive plan to get the non-recognition treatment of Section 351 and then immediately sell the shares. So the control requirement is not met. Charles had a prearranged plan to sell a sufficient amount of shares to fail the control test. Only if Sam were considered to be a transferor would the transaction meet the requirements of Section 351.